Good afternoon and welcome to the Research IP Fund Manager of the Year Awards for 2021. Well, who would have thought that we would long so much for a haircut? Hey, Andy. I guess if nothing else, we have managed to reduce our carbon footprint by not jumping on a plane again for this year's awards. These awards could not go ahead without your support. Research IP would like to acknowledge all fund managers shortlisted this afternoon and thank those of you who are joining us today. We would also like to thank everyone who took part in the survey for advisor choice, something we hope makes these awards more inclusive.
Our awards recognise industry excellence and the achievements of New Zealand fund managers. Fund managers play an important role in building and protecting the future wealth of all Kiwis. Financial advisors directly influence this via their recommendations in client portfolios. It is for this reason we are here this afternoon to celebrate excellence within that industry. The Responsible Investment Award is now a major category, and we have a few insights on that.
Yeah, thanks, Des. There's a massive amount of information out there to riddle as responsible investing develops, but hopefully our paper will provide a bit more transparency on some of the key issues and give an insight into some of the nuances around responsible investing. We still think there are plenty of unanswered questions for fiduciaries and investors to consider, but we think integration of ESG factors is absolutely critical to ensuring risk-return objectives are met through time. So we're working closely with some of our consulting clients just to see how the portfolio dynamics change through time and how responsible investing will affect these.
Yeah, and that's a great point, Andy. We work with clients that run standalone portfolios as well as integrated ESG approaches. The consulting's been on a big uptick in 2021 and something we're very happy to discuss with advisors. Consulting and technology have been key growth areas of the business over the last couple of years, and it's something that we do differently. One aspect of that is fee negotiations, and that has added strong value to our consulting perspectives and our approach with clients. But fees can be complicated.
Yes, there's our ability to negotiate fees with managers on behalf of our clients is a key area where we can add value in our consulting relationships. However, on the subject of fees, data remains one of the biggest challenges in the industry, and fees are front and centre of that. In New Zealand, we see a lot of inconsistency across data sources. MER, TER, ICR, total fund charges, historic, estimated, the list is endless, it seems. Our new ripple effect reports hope to standardise the way fees and other data points are displayed, and we will soon be releasing these on a range of platforms and news feeds. Now that's enough from us. Let's now move on to our sector award categories.
The sector awards recognise fund managers with expertise in a specific category. And first up today is global fixed interest, which has not necessarily been the greatest asset class to hold through 2021 and largely still remains challenged. In saying that, not all funds have performed poorly. And the Global Fixed Interest Fund of the Year is the Milford Global Corporate Bond Fund. Congratulations to Travis and the team at Milford.
Australasian fixed interest has seen both central banks flag increases, but COVID lockdowns on both sides of the ditch have seen interest rates remain at all-time lows. The Australasian Fixed Interest Fund of the Year is the Harbour Enhanced Cash Fund. Congratulations to George and all the team at Harbour.
Northern Hemisphere managers have seen strong rental income, tenancy inquiries and low vacancy rates. This is country and sector specific. Property is recovering, whereas some infrastructure assets benefited strongly, particularly pipes and cables, whereas airports have suffered. The Global Property and Infrastructure Fund of the Year is ANZ One Answer Single Asset Class International Property Fund, which is underpinned by the Resolution Capital Investment Team. So congrats to Sonia.
Well, welcome, Ryan. I was just wondering if you could open by maybe giving us a brief overview of Trustees Executors.
Thanks, Ollie, and thanks for inviting me to be here today. Trustees Executors is New Zealand's longest serving trustee company. This year, we're proudly celebrating 140 years of helping generations of Kiwis protect their assets and secure their financial futures.
What does the future of Trustees Executors look like from here?
Thanks for asking. That's a great question. At TE, we look at ourselves as revolutionising, how we deliver our services to our clients by transforming into a data-driven organisation. And that's funny, just the 140-year-old business saying that we're a data-driven organisation, but we really are. And some of our priorities in the not so distant future, I'd say, number one, to be a class leading fintech providing quality services to support the administration and operation of financial products in New Zealand and even wider, and to be relevant when it comes to the modern investor. I think we accomplish this by providing better digital systems and data services and partnering with those people who have that same vision as us. Number two is really around harnessing powerful partnerships that help us with automation, process improvement, and really continuing to invest in improving customer outcomes and understanding what that means and going on those customer journeys. And yeah, there is the concept of reducing the total cost of ownership to support our clients and to make sure we're competitive on our fees. But by doing that, we need to bring growth and scale, and that's really what we're looking for. Number three, I think, is not only to be the custodian of that data, but to unlock that latent value of data. And I know very much business like research IP, it is all about data, and you understand the value of that data. And to us, it's about unlocking that, just like with yourselves, and being able to provide that back to our customers in a useful way to enable innovation through rapid prototyping as well, minimal investment to respond and to clients' needs, but being able to be adaptive and being able to be agile to what clients need now. Markets change so quickly, and being able to adapt to those markets is just so important.
I think everyone's focused on inflation as the key risk in financial markets, but because everyone's focused on it, it's a known unknown, right? We know inflation is real. What we're really focused on is whether that will feed into higher bond yields. We've seen higher bond yields at the short end, but it's really the long end where the risk lies. The actual risk is that something comes out of left field, and given the valuation of asset markets is quite elevated, the valuation support is so far below that something coming out of left field could really upset the apple cart.
Clearly, the re-emergence of inflation all around the OECD. We do think it's partly transitory, but only partly. I think the easiest way to think about it in the Kiwi context is that for the last couple of decades, we've been running non-tradable inflation at about 3%, but tradable inflation at about 0. Tradable inflation right now is running at 5% plus, probably going back to 2 to 3, but you put all that together and now we're running an inflation outlook in the low 3s. So we think the Reserve Bank and other central banks are dramatically behind the curve, and there could be significantly further interest rate hikes coming, or the bond market will start to send a message.
The companion piece to complacency and all-time high markets is irrational exuberance. So we don't have that now, but it's certainly something we're keeping an eye on because we are seeing those all-time highs in markets.
One that's known around the world for being a good signal is copper, and it's providing some slightly complex signaling at the moment, sitting around the 450 mark. It's not weakening despite iron ore crashing and oil rising and all the turmoil in China. So I think we're on the lookout to see where copper breaks, and certainly if it keeps going up, it's a massive signal that the world's fine and everything's coming back our way. I guess the risk is that it does fall 50 cents or $1, which for us, that would still be a big buying opportunity. But so we're quite bullish, but we'd like to see that sort of classic marker of the global economy make its next step.
We're spending a lot of time thinking at the moment about how quickly interest rates will rise, how quickly policy rates will rise, and how quickly governments and central banks will remove stimulus from the markets, because a concerted effort to reduce stimulus globally could be very unsettling for markets.
Yeah, so when we assess risk in financial markets, there's always two key ones to look at. So the first is balance sheet risk, and this is reflecting the fact that as an equity investor, you rank below debt holders. So we're always assessing the level of corporate gearing, and actually that measure of risk is quite low right now. Corporate gearing across the board is pretty low, and a lot of companies have generated a lot of cash during the pandemic. So we're feeling pretty good about that level of risk. The other risk that you're always looking at in financial markets is valuation risk. And it's not a catalyst of itself. It's high valuations aren't a catalyst in and of themselves, but they definitely magnify the downside if anything goes wrong. So the fact that we've got such high starting valuations across the board means that if anything sort of goes wrong, and I think, the last 18 months has told us that we never really know what's around the corner, mathematically a high starting point sort of magnifies the downside as markets start to price some of that bad news in.
Particularly from a consumer's perspective, and I run the International Brands Fund, one of the major issues I'm keeping an eye on is the potential hangover from the withdrawal of stimulus in the US. It has had a dramatic impact on consumer spending, particularly in the area of consumer durables, and that's driven significant uplifts in the profit margins and sales of a lot of these, particularly retailers in that area. I'd encourage people to have a look at what happened to the sales of Harvey Norman and then Woolworths Electronics division in response to the stimulus, this much smaller stimulus in Australia during the financial crisis. And you'll see that it is pretty dramatic impact, and in the States it's even bigger. And I think once we get past that, you'll see a much larger impact than people expect.
Yeah, so it's fair to say the kind of key risks are around central bank policy with rising interest rates on the back of rising inflation. So inflation has probably been more than transitory, and there's a concern now that it's beginning a bit more structural, and it might be more around for the medium term. So how central banks react to that, and the knock-on effect of how markets will subsequently react to that, is probably the biggest risk we're seeing in financial markets at the moment.
And globally, we're seeing bigger divergences in central banks' communications and actions, with the larger central banks like the Fed and ECB being a bit more patient, and the smaller central banks like New Zealand and the Norges Bank and emerging market banks starting to hike interest rates. And I think it's also interesting to note that China hasn't provided as much stimulus as they would have historically as well. So what those two things mean is that we're in a different environment as we were after the GFC, with more broad-based inflation pressure and a different stance from China. And given that, plus changes to central bank mandates, high levels of government and household debt, elevated asset prices which stem from low interest rates, there's quite a lot of things going on there. And I would agree that the risk of a policy error in that environment is particularly high outside of New Zealand as well.
The Southern Hemisphere is loudly calling out for freedom from COVID lockdowns. Is office property finished? Based on fund manager responses in our video today, there will be a mix of office versus work from home. Similar to global property and infrastructure, underlying sectors have behaved very differently. The Australasian Property Fund of the Year is the AMP Capital Australasian Property Index Fund. So congratulations to the computer.
Alternatives spans across water, natural resources, hedge funds, and long-short strategies. It is very broad and often lowly correlated to traditional assets. Some alternative strategies can therefore offer real diversification in a portfolio. The Alternatives Fund of the Year is Janice Henderson Global Natural Resources Fund. Congrats to Dan and the team across the Tasman.
Absolutely. Given the risks that rising interest rates would pose for all assets, having lower duration or even negative duration in the long end, I think is really quite an effective hedge against rising rates causing upset in valuation of asset markets.
Absolutely. I guess as an overall comment, equities are a surprisingly good hedge against inflation. until inflation gets into around the 3.5–4% region, is what all the historical data says. Because obviously you have a higher discount rate, which is a negative, but you have higher nominal earnings growth, which is a positive.
The short answer to that is no. I can expand on that if you want, or if you like a punchy no, you can just go no.
We've been underweight the two major bond proxies in New Zealand really are listed property, which does get rental increases, but cap rates plus rising interest rates tend to outweigh that in the early parts of the cycle. And the other big part is the gen-tailers, or the electricity generators and retailers, which are just being priced as absolute bond proxies. They're still good businesses, they're still growing. They don't have the same valuation problem that the other stocks have, but they've just got far too expensive. Valuation problems to interest rates, so they're far too expensive. And then on the other side of that, we're trying to look for pricing power for companies that are able to put through these price increases, hold on to a bit of margin on the way through, not see themselves get squeezed. So with some of the domestic cyclicals are having a very good run right now, as they're able to hold pricing power at the same time as costs increase. So that's kind of what we've done.
When we invest, we're looking for companies that have the potential to significantly increase their earnings in 3 to 5 years' time. And typically we like to do that regardless of what's happening with interest rates, whether they're going up or whether they're going down. We want the ability of that company to significantly increase earnings to be within its own control, not beholden to any external factors. And as a result of that, you don't see thematics like interest rate sensitives or positioning at a fund level as a result. As I said before, we do discuss macro risks, and we don't want the portfolio to be exposed to a factor by lots of holdings having the same issue. But it's really not a factor for us. I think what we might see if interest rates do keep rising, you might see some more of those infrastructure, long-dated assets come into our funds as they become more affordable, because they have been at the epicenter of the zero interest rate trade. And they'll shift out of that. And shifting out of that means share prices getting back to more normal levels.
Yes, we've had a view that interest rates are going to rise for some time now, and that's been most evident in our relative duration positioning in New Zealand. However, the story in New Zealand is a bit more nuanced relative to the rest of the world, because interest rates have already started to rise and they've risen a lot. So we've actually been gradually increasing our duration over 2021. We still remain below benchmark, but it's getting more and more attractive now in New Zealand. In Australia and the US, we think interest rates have a lot further to go.
There is not much more to say than global equities remain expensive. Indices are heading to all-time highs. Notably, though, there has been a recent change to outflows from passive investing. Does this signal a transition point for active fund managers? We will see. The Global Equities Fund of the Year is Russell Global Opportunities New Zealand Hedge Fund. Congrats to the team at Russell.
The Australian economy has been driven by lockdowns across New South Wales and Victoria. With e-commerce, digital ordering, delivery of food and beverages, cashless transactions, work from home, and a preference for active versus formal wear influencing prices. Macro drivers like China and the transition to the carbon economy have the potential for longer-term structural drivers. The Australian Equities Fund of the Year is the Hyperion Australian Growth Companies Fund. Congratulations to Jason and Mark at Hyperion.
And the winner is the ASX, mainly due to the NZX suffering a 6% fall in Q1 this year, recovering to be largely flat for the 12 months. While the ASX has grown by over 13% for the year. Actively managing the portfolio, sectors and companies has been key to generating a strong result for investors. The Australasian Equities Fund of the Year is the Pi Australasian Dividend Fund. Congratulations to the mites at Pi Funds.
Topical stocks within the top 20 companies have driven markets. Has the A2 bubble burst? Is Fisher & Paykel the best company in the NZX? Active managers can navigate these changes. The New Zealand Equities Fund of the Year is Fisher New Zealand Growth Fund. Congrats to Sam and the team at Fisher's.
And for 2021, Research IP has changed the process, pitting all funds from conservative to high growth to flexible asset allocations against each other. Over the long term, we expect all diversified asset allocations to have their day in the sun. It is now a battle of the asset allocation and focusing on the fund rather than the manager. This will highlight the changes in the market and when an underlying asset class, that is bonds or equities, is performing strongly. The Diversified Fund of the Year is the Milford Australian Absolute Growth Pie Fund. Congrats to Will and the team. That concludes proceedings for the first part of the afternoon. Congratulations to all of today's winners and finalists so far. We will return shortly to present the major awards. I'm sorry that I'm boring you to tears.
So what is the future of
Yeah, that's cool, mate.
Coming strong. This one's way too much text.
Who wrote it?
Some forum.
Try not to swear when you do that, and then I can use it as a blooper.
Now I'm going to make sure I swear all the time. I can't make it to the blooper reel.
There's a good
Should have
beat.
sworn in the middle of that. Damn.
Love it is the short answer, and that's the beauty of what COVID has done for the world. Almost it happened alongside new technologies that actually make working from home easy, and has allowed people to realise that flexible working, work from home when it makes sense and work from the office when it makes sense, it is completely doable. We were lucky in that we were what's called born in the cloud, being a relatively young business, and the office will become more a place of collaboration.
For me, it's mixed. I miss the ability to have deeper conversations and arguments with team members, but I also like the ability to filter out distractions when I'm working at home.
That's a good question. For me, it's a bit of a love-hate. I love the flexibility, no commute time, casual working from home attire. But I hate that I don't get to go face to face with a lot of conversations and connect with colleagues, which I have usually done in the past. For me, I think there is something to be said about meeting people face to face and being able to look them directly in the eyes. Video conferencing's been great, but I do miss that sort of human contact sometimes.
I've notched up 12 months plus of working from home, so in 2 different countries. So I'm probably firmly in the hated camp.
I think everyone's a little bit over it. I'm actually quite heavily pregnant right now, so I'm loving the mix. So we're now back in the office maybe 2 days a week, which is probably all that I can really handle in terms of sitting at a desk all day.
I don't mind it. I think it's although I must admit the glass has come off a little. But I think what I miss is the spontaneity of conversation that you get in the office amongst the team, especially when you're sitting around listening to the bond guys and their sort of pessimistic glass half full kind of view of the world. You kind of miss that as an equity guy.
My view is I hate it. I'm a person that gets energy from people, not screens, and really in an investment management company like ourselves, it's so much better to be around people face to face as well as our clients. So that's been probably the hardest part, and never really feeling that you've left work, because your house, your home, your kitchen or your dining room is your office. And I suspect that many people will be very, very pleased to get out and come back when we get that opportunity.
I love working from home, but I do miss people. But when I think about that, I think everyone is actually just a Zoom or a Teams call away, aren't they? Case in point. And actually, we're seeing amazing connections across our New Zealand and global business as a result of changing the way that we've worked. So overall, it gets a vote for me.
Advisor choice was initiated in 2019 in an attempt to make fund manager awards a more inclusive process. The awards continue to prove popular for the 3rd year running, and I'd like to congratulate those managers who have been clearly active in promoting their strategies in the advisor choice categories. The following managers received the most individual votes in each of the respective categories. The winner of advisor choice for equities is Fisher Funds Management. The winner of advisor choice for fixed income is Harbour Asset Management. The winner of advisor choice for property and infrastructure is Fisher Funds Management. The winner of advisor choice for KiwiSaver is Generate Investment Management. Well done and congratulations to each of the winning fund managers.
Yeah, well, I think we just answered that. The answer is no.
Yes. Yes.
Yeah, in terms of being back at the office on a full-time basis, yeah, absolutely.
Businesses like ours are collaborative and rely on different people's experiences and knowledges to do a good job. So yes, I see us being back in the office because that's the best way to collaborate effectively. But there'll be more flexibility, obviously, and less business travel around that.
People will come back into the office, but I don't think for most people it's going to be on a full-time basis. We have a flexible arrangement at TA based on your role, etc. We allow some of that flexibility or quite a lot of flexibility for our staff. And we think that sort of hybrid model is going to be the new normal.
At Research IP, we think a little differently. Many will know us for our qualitative research, some for our consulting services, and soon a lot more about our integrated technology solutions. However, there is one overarching theme in everything that we do, and that is we are not a Me Too provider. We are actively disrupting the industry in which we operate, and we aim to provide better solutions to the marketplace. So without leaving you in suspense any longer,
Responsible investing has been upgraded to a major category for 2021, with the award recognising the manager that demonstrates the most commitment to responsible investing and its benefit to stakeholders. Greenwashing and token signatories to either the UNPRI or bodies like RIA will no longer cut the mustard. ESG is not new. The focus of Research IP is the evolution to sustainability and impact, the transition to carbon neutral, and the important role capital must play in keeping the lights on yesterday, today, and tomorrow. The Responsible Investment Manager of the Year for the 2nd year running is Pathfinder Asset Management. Congrats to John, Paul, and the Pathfinder team.
We're pleased to be involved by having representation in one of these, the Investment Implementation Group. The group's objective is to examine the overall state of the responsible investing, sustainable finance markets in New Zealand and to work out a possible approach for linking the investment markets and driving sustainability into the mainstream of activity into our country. As a supervisor, as an administrator, we believe that responsible investing is hugely impactful to the markets and therefore needs to be hugely important to our clients who are investment managers. In our corporate trust business, we are the supervisor too and have assisted a number of our clients in bringing their ethical and social responsible funds to the market.
It's a combination of screening, integration and engagement.
Within the equity space, we integrate responsible investing scores into our quantitative framework, but we also engage with companies on a regular basis through this process to get the score, and that occurs on an annual basis. And that is a predominant thematic or criteria that we use to integrate it into our process.
It's integration. So we have full integration across the different strategies that we have. Responsible investing and recognition of all factors which are environmental, social, and governance is something which we've always put a huge amount of effort and time into, and we're very proud of that. And all of our investment processes recognise the importance of it, and we ensure that it's represented both in terms of the way that we assess individual stocks and the way that we build portfolios.
It does vary a little bit by fund. For example, I'd describe our long-short fund as being very much on a continuum of traditional and responsible. So, negative screening, full consideration of ESG risks, total embedding of ESG risks into our modelling, and into the portfolio ranking output, and considerable interaction with companies where necessary. But some elements of traditional as well. The long-only equity funds I'd put much more firmly in the responsible part of the spectrum, which and perhaps moving into some elements of sustainable over time, as it's becoming very apparent that excess returns may accrue if you have the right investments and the right opportunities. And various elements of sustainability.
We take an integration approach, as we have an ESG policy, we have an ESG committee, and unlike a lot of managers, is we don't greenwash. We don't set out to be a pure ESG focused manager. We are a manager in 2021, nearly 2022, and this is just part and parcel of what you have to do when you look at investments now. So that's how we view it, as our investors have an expectation that certain types of companies are on an exclusion list, which we follow. And then, when we have company interviews, there's certain types of questions which we will ask, but we're not specifically targeting a certain type of business.
In our private wealth business, the growing awareness of investing ethically is something many of our investors are seeking to adopt in their investment philosophies around TE's social responsible investment portfolios. Our in-house investment services team have a deep expertise, and we specialise in selecting and managing a number of SRI portfolios on behalf of our retail clients, including a number of charitable trusts. And many of our portfolios look to invest in a diversified range of investments that have significantly lower carbon exposure than the overall market.
We do engage. We are not what we would call activist. So we engage on issues that we think companies can improve on in an active shareholder sense, not an activist shareholder sense. And we do have some screens, and those screens are predominantly aimed at the activities that we have excluded as part of our SRI policy. But the main thrust of what we do in a responsible investment sense is actually integrated into our investment process.
We use an integrated approach, and to us that means not just exclusions and investing in themes and engaging with companies, also looking for impact investments. That is an integrated approach, and reporting on it as well.
Think about responsible investment from every angle we can, to be fair.
Our awards recognise Fund Manager of the Year, but we feel it is important to recognise the managers that consistently deliver strong risk-adjusted returns over the longer term. And the winner of the Longevity Award 2021 is the Harbour T. Rowe Price Global Equity Fund. So congrats to Scott and the T. Rowe Price team, as well as the Harbour team, for bringing this strategy to the New Zealand market.
There is a funds under management link to the Boutique Fund Manager of the Year award. At Research IP, we feel it is important part of the marketplace to recognise. However, it is becoming increasingly difficult because of the significant inflows and market performance that the industry has seen. The Boutique Fund Manager of the Year is Salt Funds Management. Congratulations to Matt and the team at Salt.
Retirement savings is increasingly important, possibly the only investment for many Kiwis into a managed fund. KiwiSaver continues to grow, and as of December this year has undergone its second major restructure of the default provider process. While the growth of new KiwiSaver accounts is less critical, every little bit helps in a very competitive marketplace. Managers in this sector also play an important role in educating Kiwis on the value of saving and investing. The KiwiSaver Manager of the Year is Milford Asset Management. Congratulations to the team at Milford.
Yeah, so Harbour is, we've gone down the route of getting Toitū carbon zero certification. So we're very much focused on that as a business. We're providing offsets to our emissions where we can by helping out some projects in India actually to help conversion of coal-fired, boilers for individuals and households and converting them to more greener options.
Yes, we've actually measured it. Our best guesstimate is it's about 4.1 tonnes per year, which compares to the average household of about 8 tonnes per year. You know, we're a pretty small firm. You know, we rent 170 square metres. So the cost of offsetting that would be about $267 at current carbon prices. Interestingly though, as part of running the carbon fund, our inventory of carbon units on average is probably closer to 1 million tonnes. Now, unless we cancel those units forever, you haven't actually offset it. But the fact that we're effectively holding that forever, you know, is an interesting temporary offset, if you like.
We think about carbon emissions in Scope 1, Scope 2 and Scope 3. So Scope 1 and 2 are our business emissions, and we reduce as much as we can and buy carbon credits to cover those. Our Scope 3 emissions we regard as our share of emissions from the companies we invest in. We have driven our equity portfolio, the carbon footprint of about 65% less than the market, and our business has bought carbon credits to cover the remainder to make, for example, our KiwiSaver net zero at the moment. So yes, we're very, very mindful of carbon footprints. We see climate change as the greatest challenge for not just for investors, but it's the greatest challenge for our planet and our civilization. So we need to manage in a low carbon future.
We are actually, as a business, carbon neutral, and we made some aspirations for that to be achieved by, I think it was 2017, but we actually managed to do it a couple of years ahead of target. And that's by actually managing it within the business, not offsetting or anything like that. And because this is important to us, we've actually been managing the carbon footprint of a lot of our funds now for well over 10 years.
As part of the ESG, and in particular in reducing our own carbon footprint, we have for a number of years been looking at our energy and emissions. Even pre-COVID, we introduced Microsoft Teams for video conferencing, technology to reduce travel and to essential need only. We offset our carbon emissions for those staff who do travel, reducing our energy consumption by daylight harvesting across our offices and encouraging other modes of transport for our people. In recent years, TE has made conscious effort to reduce paper. Going digital has reduced the number or need of paper, and also puts us in a much better position to work from home and to collaborate with minimal disruptions.
Absolutely. Mercer is committed to carbon reduction. On the company front, in January this year, Dan Glazer, who's the global president and CEO of Marsh McLennan Companies, of which Mercer is a part, announced that the whole group would be certified carbon neutral this year, and also committed to a further 15% reduction of overall carbon emissions by 2025. On the funds management front, we're also committed to the carbon footprint management. And in July this year, we announced a target of net zero absolute carbon emissions by 2050 for our investment funds. As Ronan said, that's an $11 billion book at the moment. And we expect to reduce carbon emissions for that portfolio by 45% by 2030. And that announcement follows similar commitments that have already been made for the Mercer funds in Australia, the UK, Europe, Asia, and we anticipate Canada following suit soon. So Mercer absolutely committed to reducing our carbon footprint as a company and as a fund manager.
As we've said, 2021 has been a very different year in so many ways. We started 2021 discussing the awards with the intention of running the event on the rooftop bar at the Ridges Hotel in October. As an MIQ venue, and with Auckland's prolonged lockdown, those plans disappeared. I would like to thank the team at Research IP for the effort that's been put into making this event happen. Research IP has a growing footprint in New Zealand, commercially via its research, consulting, and Flint Wealth. And as you are probably aware, Research IP has been fortunate enough to retain the talents of Andy Marnie, who most of you should know. But if not, I ask that you reach out and get to know our local team.
On behalf of Research IP, I would like to extend our congratulations to all the shortlisted, the finalists, and the winners today. Thank you for your support over 2021 and all the best for the festive season. We now come to the final award. Each have a drink ready, be it sparkling soda water, a Kiwi crafty, or a flute of sparkling. Please charge your glasses for the finalists for Fund Manager of the Year 2021.
To be eligible, you need to have been a finalist or shortlisted in more than one category. Consistently performing across the product suite and passing a range of qualitative criteria, covering corporate and investment governance, philosophy and process, portfolio construction and implementation, risk management, and of course, fees are the prerequisite to get on this list. As always, it was a very close race to the finish this year, with strong performance and representation across multiple sectors by our finalists. But there can be only one winner. The Research IP Fund Manager of the Year 2021 is Milford Asset Management. Congratulations to Mark, Wayne, and the whole team at Milford.
There's a party going on right here, a celebration to last through all the years. So bring your good times and your laughter too. We gonna celebrate your party with you. Come on.
We're on good to go.
Smiling.
But what are you wearing under the desk?
Good question. You know, it's you can see the tie and the press shirt and the jacket, but I'm actually sitting here in a pair of tracksuit pants and a pair of moccasins underneath that, and that's good. I'm working from home.
Ask my wife. She did inform me the other day that it's time to go back to work.
Sometimes you want to go to the office though for a bit of a change in scenery.
Had to laugh today though, just classic working from home. I was talking to a broker, had my phone on speaker, and his dog went crazy in the background, and you should have seen our cat move.
Is that your dog barking?
Yeah.
Okay.
Can you just do your hair one more time, just so that I can get it on the outtakes?
Do my hair.
Jealousy will get me nowhere.
Mate, we should be recording in the 1970s with this haircut.
At Research IP, we think a little differently.
Start again.
Many will know us for our...
Andy was doing his hair again.
You've just smashed it out of the park on that response, Matt.
I was going to say that after we might...
We are going to edit that beautifully and take some of that out and lift it in, because some of it's gold.
I was going to say, I think that's the best one we've had so far. We've had a lot. I think that's the most accurate answer in terms of dollars.
That's what comes from running the carbon fund. We feel as though we'd better actually know what's our own, what our own footprint is.
Yeah,
that's the only response I've heard with an inbuilt carbon hedge. I'm sorry that I'm boring you to tears.
So what is the future of?
That's cool, mate.
Strong. This one's way too much text.
Who wrote it?
Some forum.
Try not to swear when you do that, and then I can use it as a blooper.
Now I'm going to make sure I swear all the time. I can't make it to the blooper reel.
There's a good
should have sworn in the middle of that. Damn.
To laugh through it all.